All right, everyone. Thank you for reading through those disclosures and welcome to another one of Avant-Garde Trading's free educational trading webinars. This afternoon, we are happy to host Vlad Karpel. He is joining us to talk through some lunchtime options trading with you all. He's going to talk about, some key trading metrics, talk about return on capital, probability of success, and some estimated moves, and help us navigate today's market environment with a quick little chat over our lunch breaks. Vlad, are you with us?
Yes, thank you for having me.
Thank you for being here. We're excited to have you. And I do believe we might have a little surprise pop-in guest as well, who may be commenting here and there, hiding in the shadows. Who's with us here?
Yeah, thank you, Natalie. Keith Harwood here as well. So happy to join as well and talk through some stuff with Vlad and the crew here today. So
Yeah, awesome. What a good surprise. Thanks for joining us, Keith. But we'll let Vlad take the wheel here and run the show. So Vlad, when you're ready, you can go ahead and share your screen and begin your presentation. And I'll just remind everyone who's with us live, if you have questions during the presentation, please type those into the chat and I'll get those over to Vlad and possibly Keith at the end for them to address. Okay, Vlad, I can see your presentation, so you can go ahead and get started.
Perfect. And you guys can hear me?
Yes.
Perfect. Thank you. Well, again, thank you, Natalie. Thank you, AGT of Trading, for inviting me and giving me the opportunity to present on options trading. As Natalie alluded, we're going to talk about, I think, one of the most important topics in options trading, and not even options trading, just trading in general, such as probability of success, distribution of possible outcomes, return on capital, estimated move. This is my brief bio. I've been trading for over 25 years now. My background is technology, so I worked at several broker-dealers and built the technology for retail investors, and with a lot of AI background, learning on price actions, learning on the earnings data, and providing forecast based on the AI models. And obviously there has been a lot of advances in the past few years. So that's my background. We also have Keith with Options Hotline. Keith, you want to maybe give a little bit background about yourself?
yeah, absolutely. Yeah. So different background from Vlad. I actually started as a market maker back on the CBOE floor in 2005. So I've been trading for about 20 years. And I've worked as a market maker, proprietary trader, hedge fund trader, and in the educational space for about 8 years now. So, I tend to focus on options analytics and things of that nature versus, I think, Vlad's background, very quant AI focused. So it's a good mix of, I think, ideas and approaches to the market here that we can help hopefully, give you guys some good background and some ideas in current market conditions.
Perfect. Thank you, Keith. Welcome. I'm glad you were able to join. In terms of disclosures, I'm gonna go through some of the trading concepts and show you a trading screen. So just want to make sure that disclosures are out of the way. If you haven't seen disclosures before, I do encourage you to visit optionscreening.com, the link on your screen, to understand the risk and suitability involved in trading options. I'm not a financial advisor. I'm not registered with FINRA nor SEC. Keith is not a registered advisor. And we're here solely for general education purposes only. All right, so always want to start with just main concepts of trading, right? The goal is to become consistent, confident trader, right? Build a repeatable process that you can create a trading plan, document the rules, and continue to repeat that process. And it doesn't matter what product you're using. It could be futures, it could be options, it could be Bitcoin, but the process is the same, right? Very important to determine position size, right? Position management, trading psychology is probably one of the most important concepts of consistent, successful trading, is that you know what your exposure to the market is, you know what that position size is. In terms of next one is avoiding, right? Trading psychology, being self-aware. Not only do you want to predict what the next move in the market will be, but how well can you predict if the market goes against you? How well can you deal with the potential losses? So that's a very important concept, right? Trading psychology, emotional intelligence. We're going to cover more on that in future webinars. We're going to talk about in details about profitability of success and return on capital. Again, hedging portfolio, managing your portfolio, position size, total drawdown. And you want to build a trading plan, stick to it, have a trading journal. I encourage everybody to have a journal and just keep writing, have a checklist every time you trade, before you place a trade. All right. So first is, to me, trading, whether it's an option trader or a futures trading, it is a distribution of possible outcomes, right? You go back to your statistics class, you have one standard deviation move, two standard deviation move. We have unemployment data tomorrow, right? Market could move one standard deviation to the right. You can move one standard deviation to the right. If you're not, this is kind of a refresher course on, what a, high school, college, basic statistics class, right? The idea is that it helps you determine resistance and support in the market, right? And I actually kind of prepared kind of quick demo here. This is bar chart. You can use charting for bar chart. This shows you distribution of possible outcomes for SPX, right? Cash settle options. So you can tell that market anticipates potentially 1% move, 1.3% move. As a result of the unemployment data tomorrow. So between today and end of Friday, market could move 1.3% to the upside, 1.3% to the downside. I mean, you can have an opinion whether it's going to be a bullish print or a bearish number, but that is where, based on the demand and supply for options data, this is what the market expects. And one standard deviation is 68% probability. Sometimes you have two standard deviations. If it's really bad, if there's a big jump in unemployment data, then the market could move beyond 1.3%, could move 2%, right? And by looking at the options data, right, by looking at the pricing for the options data that expires today or expires tomorrow with 0 days till expiration, you can actually determine what that range the stock or underlying asset can trade based on the options data. Again, simpler example is rolling two dice. I mean, that's probably the most, simple, one of the basic examples when you take statistics class, or if you go to casino, right? You roll two dice, and then most people don't know what, or you don't even think about it, right? But if you do go through the statistics, you know that 7 comes up more often than not, right? The highest probability of the outcome out of all the permutations of two dice, right? From 2 to 12. So 7 has the highest, maybe 17%, right? And then if you look at 6 and 8, then between 6, 7, and 8, it's 14% plus 17% plus 14%. So if you want to try to figure out what is the most common outcome as a result of that action of rolling two dice, then it's more often than, half of the time it's 6, 7, 8. If you think it's going to be 2, right? Well, that happens only 3% of the time that you can get both dice to show 2. Stock market or futures market or equity, it's exactly the same approach, right? It's exactly the same approach. You can decide that I want to see, I want to kind of think, I think 2 is going to be the case, and which is totally fine, just as long as you understand that the probability of that event is smaller, but obviously potential return on that decision is much higher, right? So probability of success and return on capital, they always go hand in hand. What influences this range, where the stock market or options market, futures market is trading? It's influenced by supply and demand for options, right? Or the level of uncertainty, right? So usually in front of the earnings, let's say Broadcom is announcing earnings tonight. In front of that event, if you look at the volatility of Broadcom, let's look at the volatility chart. Let's look at the Broadcom. All right, so if I look at first of all, you can see the highest implied volatility right is in front of the earnings, because this is the highest level of uncertainty, right? There's a lot of expectations for Broadcom maintaining the AI theme, and there's a lot of premium in these options. So for Broadcom, it's not going to be 1.3% move for tomorrow. It will be significantly higher based on, again, historical, historical volatility. I mean, implied volatility. So you can see the IV rank going to the earnings. Each of the earnings, you can see that, green line, implied volatility in IV rank is approaching the highs. When the level of uncertainty drops, then the range where the Broadcom can trade, it also drops as well. So implied volatility is just demand and supply for options data, right? How many contracts at certain strikes people buy, right? What they're willing to pay for it. And then historical volatility is backward looking, right? You can look at the 50 days, moves in how much stock has been moving past 50 days. And after the volatility, or after the event, whether it's unemployment data or whether it's a Broadcom earnings, that range is going to collapse, right? It's going to trade in much narrower range because there's less uncertainty, right? So when I think about volatility, I think about uncertainty. When uncertainty is elevated, then volatility, that means volatility is higher and the range is going to trade in a wider range. So again, the number one question that you always want to ask when you're an option trader, right? The most common strategy is buying calls, right? You're buying out of the money calls with the idea that, you're going to have a high return on capital, but hopefully now we can realize that probability of success of that event is less. So you could be long, what we talk about, it could be long the volatility or short volatility, right? You can say, when I roll 2 dice, do I want to, do I want to think about that 2 is going to be outcome, or do I want to think about that 6, 7, and 8, right? When you're selecting 6, 7, and 8, you basically you think that the stock will move within that one standard deviation, right? And you can do market neutral strategy, right? You can sell premium, you can sell call spread, you can sell put spread, you can sell both, such as iron contract, but you sell in premium, right? You're receiving money for your transactions. If you think it's going to stay within the range, then you can buy calls, you can buy puts, right? If the market implies that tomorrow stock market is going to move only 1%, but you think if it's going to be bad earnings or really good earnings, it's going to move 2%, well, then you can buy put or you can buy call, depending on your view. Or if you're not sure, you can buy both put and call, right? And as long as the move is beyond what everybody expects, then this would be a profitable trade. If it's going to be less than what everybody expects, then due to time decay, your probability, it will be a losing trade. So very important to look at the IV rank, probability of success, right? That range, what everybody expects versus what you think, right? And what everybody expects, you can look at the options data and make that determination. You can always look at the more complicated concepts like gamma exposure, VANA, right? The second derivatives, but this is more complicated, but idea is the same thing. When you look at the gamma versus VANA, when you look at the open interest, it basically shows you where's the highest concentration of open interest at certain strikes, right? The way, like when I try to think about it, I basically look, here it's the put wall and the call wall, right? 6,500 on XPX. So right now the highest concentration of puts and calls at the 6,500 strike. So we need very positive catalyst, some very good earnings, and maybe the CPI data going down next week and PPI on Tuesday and Wednesday to break through that wall of 6,500. So math behind return on capital, one thing that kind of, it might be intuitive, but sometimes it's hard to express it, is that for regular average trader, retail trader, right, you can have high probability of success and high return on capital, right? You can't select that if I roll 2 dice, I'm going to get 2 more than 50% of the time. That never happens when you roll 2 dice. It never happens in the stock market, right? So if you think that the market, based on today's VIX, under 20, we expect 1% move tomorrow. But if you think you want to buy calls and puts, right, because you think that the market is going to move 2%, you're going to get a higher return on capital, right? But your probability of success will be lower, right? You can have a setup where you have a high probability of success, right? Where you select 2 or 10, but it happens more than 50% of the time. That doesn't exist. That's why most retail investors buy calls, out of the money calls, with the hope that the stock is going to move beyond the expected value. But because of the time decay, 80, 90% of these trades are losing trades because market is efficient enough to find supply and demand for option contracts and tell you what the range is. And if you think it's going to move beyond that range, well, most of the time you're going to be incorrect. But when you are correct, then that's when high return on capital, low probability of success happens. So some of the math behind, we can do a simple example of a debit spread. We can do it even on Spider since we talked about this. So debit spread, right? This is an example of debit call spread, right? So we can set it up tomorrow. How do you determine the calculation, right? So you look at the difference in strikes, right? Minus the premium. The debit spread is, you look at the ask of the buy, right? Maximum loss is the debit that you pay. So it's the ask of the buy leg and the bid of the sell leg, right? You take the difference of two, right? So this is the maximum amount of money you can lose, right? We'll go through the specific example. And then the maximum gain is, when you do a debit spread, is the difference in strikes, right? If it's a $5 spread, difference in strikes, minus the debit that you just paid, right? Minus the debit you just paid. So let's go through that specific example, and we can look at the spiders. So let's look at spiders. I was doing Meta, but I think since we're sticking with SPX, we're going to do spiders. Spiders just divide by 10 the SPX, cash settle index, probably the most liquid name. And we can talk about tomorrow, right? So tomorrow we have Friday expiration, right? And let's say let's say you think it's going to move beyond 1%, right? And we're going to break this 650 call wall, right? So then you buy 650 call, right? You can sell, let's say 655. Let's see. That's not a lot of premium, but I mean, for the sake of example, we can do this. So basically, I'm spending here, I'm buying the long leg. Let me just zoom in, just make sure you guys can see it better, right? So I'm buying 650 call and I'm selling 655 call. 650 call right now, 78 cents. And I'm receiving a credit of 7 cents. Keith might say this is not enough premium, maybe 53, but for the sake of example, you understand. So the maximum loss right now, if I put this trade on exchange, is 71 cents. If I buy this at the natural ask, right, the spread 79, take 79 divided by minus 7, sorry, 79 minus 7, 72 cents. So the maximum amount of risk that I can have in this example is 72 cents. What is my maximum profit? Well, it's a difference in strikes. So if the stock market actually moves, let's say, well, in this example, actually exactly 1 standard deviation. So if it does move 1.3 standard deviation, right? If it 1.3%, 1 standard deviation, if it does move to 655 and closes above 650 and 655, then 73 cents. So my maximum gain would be $5, the difference in strike, in this case 5, minus the 73 cents that I'm paying. Right? And you can see it here in a similar example. If we go through, let's do the same thing for spiders. Let's do spiders. Let's see, there's 650, 655 call spread. 649. Let's do $1 spread. So same idea. All right, so this is buying 649 call, right? Selling 650 call that expires tomorrow, right? And you can see that the risk, the maximum risk, is the debit that you're paying, right? The debit that you're paying. So $1.02 minus 68, this is what, roughly $34. Let me just confirm that. Maximum loss, $34. Yeah, 68 plus 34 is $1.02. Right, so that's your maximum loss is 34 cents. If I'm buying 649 call and selling 650 call. Right, I would just have to change this to 649, 650. And if you guys have any questions, I know it's a lot of content that I'm covering in a relatively short period of time. So I would, if you have specific questions about return on capital or probability of success, that would be very useful. Okay, so 649, 650, I'm paying 37 cents based on these quotes. So here's 34 cents is your maximum loss, right? You can see it on your chart. Maximum gain, right, is $66. It's the difference in strike, which is $1 minus the debit that you paid, 34 cents. So my maximum profit is $66. My maximum loss is $34. And all it needs to do is move within that one standard deviation, but it has to be positive surprise, right? It has to be positive surprise. And same thing could be done on the downside with debit put spread. Any questions on the setup for the spread at the maximum profit, maximum risk? You can also look at the volatility. I mean, volatility is low, VIX is low. So it shows you that right now it makes sense to be long vol, right? Because you don't have to pay a lot of premium. But maybe people are underestimating tomorrow, Broadcom earnings tonight and then the unemployment data tomorrow. Any questions so far? All right. So, I mean, one thing, the estimated move analysis, you can use something like this. A lot of sites will do this. So on bar chart, you can go in and basically select expiration months, right? You can say, tomorrow. And then it will tell you based on the supply and demand. There's different formulas for them, right? You can actually see that right now it's 67. So tomorrow expected move is 0.67. So right at that 649, it says 650 level, right at that 650 level. If you want to select, the next day, by Monday, end of Monday, then it's 0.8%, 0.8%. Another kind of formula that I use very quickly, you look at the money puts and calls. You add the money put, add the money call. In this example, 219. So 277, 277, right? You add 277 and you add 209, add the money, put and call, asks, and then you do the out of the money bid for put and call, right? And these are just approximation. So 277 is this guy, 209, and then $1.51 and $1.64 for out of the money options. So, and it could be applied for any time interval for any period, right? Right, you can see right now we're trading at 646. So you can look, at the money options. So you can take 645, right, for tomorrow, right? Take 65, the asks of the put, the ask of the bid, and then take out of the money put and call and divide it by 2. And that gives you also similar number that if you look at the calculation that I just showed on the bar chart. Any questions on the estimated move analysis? Keith, anything to add?
No, I think you covered it pretty well. I mean, I think one of the big things when you look at that estimated move is effectively, for those that are familiar with like a complex strategy, you're looking at a straddle price. And a straddle is giving you the estimated move for the one day. And it's a common tool that people use when things seem like they're projecting too small of a move or too big of a move. But in practice, a lot of times we end up going with out of the money options in those scenarios. And you mentioned that idea of like betting on a 2 happening on a dice roll. What we're really betting on when we bet on a 2 in a dice roll is that the market is pricing less than 2% chance that a 2 comes up. So we don't want to take that risk if the market's pricing in a 5% chance of a two, but if they're pricing in a 1% chance of a two, instead of a 2% chance of a two, you have a positive potential return there. The thing that gets people, I think, rarely caught off guard is, a lot of times when you're playing with these out of the money options and you're trading them, you end up paying for a 5% probability on something that really only happens 2 or 3% of the time. So that's the danger that we've got when we start betting on a 2 or a 12 is overstating the possibility of success, thinking that the big return is worth it. It's buying the lottery ticket that's 1 in 292 million, like the Powerball, when the reward is less than the potential. The return really is projecting. When you've got a $2 billion Powerball, it may have a positive return, even though it's not likely to occur. When you have a $200 million Powerball, you're most likely going to lose money. It's just a matter of I guess the psychology of it. You enjoy the win and you're willing to take the loss, but it's really just gambling at that point.
Wait a minute, Keith. So you tell me I'm not going to win the Powerball?
Probably not. And if you do, I expect a
Shoot.
nice, fruit basket or something out of it.
All right, understood.
Yeah, thank you. But yeah, I mean, more likely than not, none of us are going to win the lottery. But, there's a certain element of the trading psychology that allows us or kind of rewards us more for that big potential win. At the end of the day, the expected return on that is too low to necessarily make that wager. And so, those higher probability of success trades, like you were talking about, Vlad, do tend to make a lot more sense because, they tend to hit a lot more often. And even though they're not that big win, it's a much more predictable move.
All right, thank you. Well, it's been almost half an hour. I kind of wanted to open up the floor for questions. We have a lot of participants, so this is great.
Yeah, thank you, Vlad, and thanks, Keith, for chiming in. Vlad, do you want to go down to your last screen? I just want to make sure people know how to get in contact with you should they have questions after the fact, because I know we're just doing a quick lunchtime webinar here. Everyone can write down Vlad's contact info. If you have follow-up questions after the webinar ends today, feel free to reach out to him directly. And I give a shout out to a different Keith, one of our attendees, letting me know I'm probably not going to win the Powerball tonight. Fair enough. Yes, I've heard it from 2 Keiths now, so I guess I'll take that as my chances over. But sometimes you just got to play.
We've got 2 Keith H's here, so I think the odds are now starting to go in our favor.
Yeah, but no, it's better to play the probabilities, definitely. As Vlad mentioned, if anyone does have questions, now is the time. Otherwise, please do write down the contact info Vlad's showing you right now. Reach out if you have follow-up questions. And I'm going to go ahead and take the share back just for a moment to remind everybody that Avant-Garde is running a special offer for today's webinar attendees. If you don't yet have a brokerage trading account with us over here at Avant-Garde, I encourage you to visit our site and consider opening one. We're running a special through the end of the year. If you open an account with us, you can take advantage of self-directed trading or broker-assisted trading or program trading commissions at the membership pricing for free for a limited time. So go to our website, check it out, go to the pricing page and get some more information on that pricing. Again, it's running through the end of the year. You can take advantage of our membership pricing without paying a monthly member fee and get those for a limited time. So please go ahead and reach out to our group over here at Avant-Garde. You can reach us at info@tradeagt.com or call us 312-858-5748 and get more information on that. Vlad, thank you very much for taking the time to put that presentation together and walk us through some samples. That was great. Keith, thanks for popping in and providing the additional commentary. That's always really helpful. We're going to do some more of these lunchtime options trading webinars, try to get them weekly if we can. So everyone, please keep an eye out for another invitation in your email inboxes from info@tradeagt. Sign up again, keep an eye out for the recorded replay tomorrow. Thank you, Keith. Thank you, Vlad. And thank you, everyone who signed up this afternoon and for those who participated. We'll see you at the next webinar.
Thank you for the opportunity. Thanks, everyone.
My pleasure. Have a good rest of the day, everyone. Good trading.